Good afternoon. Hello and welcome everyone. My name is Alex Chambers. I'm the Global Credit Editor IFR at Refinitiv, and I'm the moderator for today's webinar titled The Bond Market Bounce Back, Hopes and Fears. So before I introduce the speakers, I'd just like to go through a couple of housekeeping points. Please submit your questions throughout the webinar via the Q&A box, and we'll try to answer those towards the end of the session. Use the toolbar at the bottom of the webinar screen to access resources such as speaker biographies, webinar material, technical support, as well as a survey to capture your thoughts and views on the discussion. So let's get on with the introductions. Helene Durand, Deputy Editor, Credit Editor at IFR. I've got also Divyang Shah, who's a senior rates strategist at IFR. We have Greg Roumeliotis, who's corporate finance and deals editor at Reuters. Apologies, Greg, if I've mispronounced your surname. And we have Vinod Vasan, vice chairman of debt capital markets for EMEA at UBS. So I wanted to get going really with a broad overview, if that's okay, with around the policy responses from the central banks and the government on around the coronavirus. So I figure that we might as well start with the US because that's clearly been the biggest response and biggest talking point, I suppose, for the market. So, Greg, do you want to give us a little bit of a view on what your thoughts about the policy responses in the US?
Sure. So you've seen how a combination of U.S. stimulus and federal, reserve intervention has had a really dramatic response effect on the credit market. The United States, has pledged some $2.6 trillion of fiscal expenditure, and the Federal Reserve, not only has revived asset purchase programs last seen during the financial crisis, but it has ventured into new territory when it comes to buying corporate bonds, including fallen angels, companies that were recently degraded into high yield. And even though a lot of this has yet to come into effect, and the Fed, just today, when it comes to its secondary facility, it's giving out some details with regards to getting into ETFs. The effect has been pronounced across the corporate world when it comes to investment grade issuance reaching those massive levels you have seen, particularly in April. Also having the effect when it comes to some companies that were considering government aid, like Boeing, being able to borrow commercially. Spreads tightening. When it comes to the high yield market, then the impact has also been positive, but we also saw the limits of that. We saw United Airlines pull a bond issue last week after accepting some concessions highlight that there are some limits that what the Fed intervention has achieved in the high yield market. And the big question now is with regards to issuance moving forward, and as some of these asset purchases come into effect, but also when it comes to the Fed now buying at primary issuance, just looking a little bit more closely at what this does to the spreads and further issuance.
Okay, thank you. Elaine, do you want to quickly touch on what happened in Europe in terms of ECB and any other relevant responses to the crisis?
Sure. I mean, I think it's interesting. I guess the ECB already had obviously a asset purchase program in place. Although I think the expectation was that this year this was going to be wound down, etc. And that's what people were kind of tabling for. And which I guess that meant that when this kind of crisis started, they already had this kind of toolbox available to them. But I think where they've kind of gone above, and beyond what perhaps was originally expected, they then launched the PPP, which is this pandemic-specific program. And I think the effect was immediate in the support for credit market and I guess this sort of backstop offered by the central bank. I think that's enabled credit markets to restart very quickly, and perhaps if you look at pre-crisis, if you look at 2008 or 2011, the sovereign crisis, I think perhaps policymakers were a lot slower to react. I think here they were very quick and with kind of sizable envelope. ECB PPP is 750 billion. I think the expectation is that that's going to grow by another, 500 billion, if not more. This is on top of the existing asset purchase program. I think it's been, that's been key in supporting credit market. I think last week, the PPP, they bought 34 billion bonds. I think, they've not hesitated in coming in and buying in sizes. I think where maybe it differs from the Fed is high yields not included. Having said that, they target a broader range of maturities. So then maybe that's something we can kind of go into a bit more details. During the discussion.
Yeah, absolutely. So I suppose we saw those big policy responses after a dramatic hit across all financial markets. We don't really need to go into all of that right now, but I suppose we do need to consider, some of the way that played out, I suppose, and the reason why the central banks have come on board and taken action so vigorously is because of the massive disconnect between in the disconnections in the market. So, Vivian, what do you what were your big, when you were analysing the way the market was reacting to the COVID crisis developing? What did you think were the the biggest takeaways? What made you step back and wonder how are we going to get through this?
I think the way to look at it is we've had, the central bank response has been almost two-stage. So during the first stage, it was about restoring market functioning, and that process is slowly being wound down. So if you look at you've got a chart there of the 3-month T-bill spread, and you look at bid-offer spreads, not just on T-bills, but across the curve on treasuries, on the futures, even in Europe, whether it's Italian bonds or Spanish bonds or gilts in the UK, the spreads widen significantly in a lot of jurisdictions. So the first response from most of these central banks was, let's do QE to support the markets. And you can see that response is being wound down slowly, especially from the Fed, where they were buying about 75 billion a day in the initial days of the crisis mid-March. And that now is around 7 billion per day for this week. So they've wound that down slowly as the market functioning has improved. The second stage of that is support measures. I know we like to look at central banks as providing stimulus, but what they've done at this early stage of this crisis is to provide support, not just to financial markets, but now they've moved on to supporting governments and corporates, as well as the wider economy and banks with their own balance sheets. Because if you look at the balance sheets that are out there, you know, the scope for supporting or providing pandemic-related support lies with the central bank's balance sheet, and all of that risk is moving onto the central bank's balance sheet. So I think you're getting a two-stage process where financial market functioning has improved. You've seen liquidity make a comeback. You know, market depth is still an issue in some segments, and you've still got potential problems brewing. But that, you know, as long as the bond markets are functioning properly, I think the other markets can build on that improvement. Now it's about trying to get the real economy to improve, you know, making sure banks extend credit and making sure that governments have the capacity to lend. You know, Helen talked about the European response, and the PEPP was very important in that, because if you remember from the old days of the Eurozone crisis, you know, we were talking about the OMT and a support mechanism and the credit lines. Well, what the PEP did is essentially do away with all that. Now these governments can issue debt without worrying about the impact on credit markets or the spreads or fragmentation, as the ECB likes to call it. And a lot of that support will help governments fund and make sure that the recovery is firmer as we go beyond the virus peak.
Thank you, Divyang. I mean, you touched on something there where you said there could be problems brewing. Are you talking about financial markets, or are you talking around potentially the German Constitutional Court ruling last week?
Well, I think there's two things there. I mean, on the German Constitutional Court ruling, the GCC ruling, initially it was thought this is significant, but we've now realized, following the statements by the European Court of Justice and the Commission President over the weekend, that you know, if there's anyone that stepped over the line or potentially broken the rules, it's not the ECB, but the German Constitutional Court. In terms of markets, you know, the ECB and the PEP and the PSPP, I don't think it's going to be affecting them in terms of how they handle their measures. What we now have is a legal mess, and I'm not a legal expert as to how the Bundesbank and Chancellor Merkel will sort out the issue with the German Constitutional Court, but it is something that legally has to be resolved. But in terms of the ECB, I think their hands are not tied. On the second part, in terms of potential dislocations in other segments of the markets, we just don't know. You know, we saw what happened to oil with the May WTI futures turning a negative. We don't know where that next dislocation is going to come from, but we are on the lookout for it.
Okay. I suppose there was a dislocation in the credit space. I wanted to kind of touch on that. Why was illiquidity such a factor for the credit markets? Vinod, would you be able to give some color on that?
Yes, sure. Thanks, Alex. Yeah, the credit markets were affected by illiquidity, I think, in a different way to equity. And there's a structural reason probably that underpins that, because you've got an OTC market, you have non-homogeneous products. So one company will have maybe 20 lines of bonds often or more, and you have large denominations. So there's one is a structural factor. The second is government regulation, which has probably impinged on the ability for the street or for banks to provide that liquidity buffer through market making, and hence you get gaps in liquidity quite quickly. There's probably some exacerbation because of things like working from home as well. So there's a simple consequence of PMs and analysts and traders working from home probably added to reaction time as well. And you saw that both on the way down and the way up.
On the way up, what do you mean? I can understand how it could happen. Why that?
On the way up, the speed of recovery was so great that you often had inability to source bonds on the way up in the same way that you couldn't sell them on the way down.
Oh, I see. I got you. So, I mean, we saw the response from the central banks, and we've obviously seen that fix some of the illiquidity. But Divyan, do you want to kind of touch on some of what happened for ETFs and why that was such a concern for the marketplace?
Yes, I think the ETF dislocation, we've got the chart there with prices diverging from net asset value, is a reflection of some of the things that Vinod was highlighting as well, where price discovery was not there, and as a result, you had this divergence.
And that divergence really shouldn't have taken place, and that's probably the reason why the Fed is now, actually in the market buying ETFs, and it did surprise some market participants that the Fed would try and do this, or would suggest that it would do this. Nonetheless, it seems to be having a positive effect. So I suppose the next point I wanted to touch on really was just issuance, because that's been, in terms of the credit market, the biggest response from outside of the official sector. Vinod, what do you think the issuance, the flavour of the new issuance has been across the? What's been driving that?
Well, clearly it's been a record-breaking year for corporate issuance, and because this is not like the financial crisis, which was hitting the banks, this is probably much more real world. The corporates have gone in to essentially bolster their liquidity positions, and at the start, when commercial paper dried up, you could see that there was a shift to try to replace that funding. But now there's probably a very large element of caution as corporates have either drawn down on RCFs just to have the cash on hand, and gone into the bond market to borrow that and to lock in for quite long periods of time, often. And it's just so that they can say, I've got X billion of cash and X billion of undrawn facilities on hand to weather whatever storm we're facing. And it does make sense in a situation where you've got quite a sharp shock to add liquidity, because it may last for a long time, or it may recover, but clearly that's going to be helpful. On the bank side, it's actually been much more circumspect. So the government facilities, as Helen mentioned, have come in very quickly this time. So banks could turn collateral into cash if they needed it. Plus the banks were in good shape. So there wasn't the capital fear element to liquidity. And so essentially banks have funded in situations where government facilities weren't covering them. like the Canadian banks doing lots of covered bonds. You've had UK non-ring-fence banks who don't have access to the government facility going into the market. And also you've seen places where there's a requirement, like a requirement to have a certain amount of bail-in funding, for example. The banks have continued to build that requirement. So, but quite a different flavor, I think, to certainly the financial crisis
and then obviously very different to what corporates have been doing. Hélène, do you want to just give us a bit of an overview of what's happening? Sorry.
Yeah, it's interesting. I guess the point you were making earlier on secondary liquidity or lack of. I think it's interesting to have seen how strong primary has been, and I think we've seen yet again how key primary can be in kind of resetting the levels and kind of guiding actually where secondary levels should be. I think that's been interesting to kind of see all that issuance that has kind of generated that liquidity across the board. I think what I wanted to talk about sovereigns and agencies a little bit more, and I think what's been interesting there is how quick sovereigns have been in coming to market to fund their COVID responses, and whether it's peripheral countries such as Spain or Italy, or core countries such as Austria and Belgium. They've all been very quick. They've also they've come in large sizes. I think arguably they've been very willing to pay higher new issue premiums, which that you don't typically see for these kind of issuers. And I think the kind of playbook that you would normally see in these syndicated sovereign deals have been sort of thrown out of the window a little bit, and it's been about getting funding through the door in large sizes and quickly. We've got the UK TMO today who's doing 12 billion, on a book of 82 billion. I think it's been impressive. I guess there's two sides, how quick sovereigns have been, how much they've raised, but I guess on the other side of that, how responsive investors have been to these transactions. And, whether it's Italy, arguably one of the kind of hardest hit countries in Europe by the virus, and potentially, with finances and, debt to GDP that weren't looking great going into this and won't look great going forward, and yet they did dual tranche transaction recently that had over 110 billion of demand, and same for Spain, and again the TMO today, which again the UK's been hit hard. And so I think it's been impressive to see how investors have bought into these transactions, and kind of how flexible these sovereigns have been in adapting. And
yeah, they've adapted very rapidly. I mean, it's an interesting point you make, and it's something that we've all seen is these huge order books, and we've seen a massive response from investors, and primary has given the wider credit market a kind of guide to where levels should be or are. However, what do you think? What are bankers telling you around the real level of demand? Could you kind of maybe point out or highlight the difference in those issues that are able to, in the long run or medium term, get support from central bank purchasing in the secondary market versus those that can't? Is that easy to discern the difference between the eligible and non-eligible new issues?
Well, I think there's a very clear gap, especially in SSA. We've seen it certainly in the case of Canadian issuers who have been coming to the European market. They're certainly not getting the same traction as a European issuer would do, and I think it's very clear on new issues. The the big kind of backstop. I apologise for the background noise. The fact that we have got the ECB playing a massive part is a key aspect to why investors are so willing to buy into these new transactions.
Divyang, do you want to talk a little bit about just the Italy situation? I mean, we've touched on that huge order book that they've managed to get on one of their recent syndications, and I suppose we're kind of honing back in on the constitutional court case, but we're also wondering about their debt to GDP metrics that have they're already at 120% around that. Is that right? Where are they now, and where do you think they're going to be going soon?
Well, Italy's unfortunately has been hard hit by the virus, and their debt to GDP stands at above 155%. So it's pretty unstable. It's stable as long as the EU is willing to help, or the ECB is willing to provide support, and that's a similar assessment to what some of the rating agencies have made. I know we had the Fitch downgrade recently, but if you look at what the other rating agencies are saying, they're saying the support from the ECB is quite critical to that debt sustainability argument, and it's an important theme because going forward, Italy will still need support, and we don't know what kind of support it will get because the EU is still working out how it wants to provide support. I know Corona bonds are not in favor, but they still have to work out something for the future. I'm not sure where it will go, but in terms of the curve and BTPs, we still prefer, the shorter end, the 2-year, and the carry and the roll on the 2-year down is very attractive. I mean, I'll give you an example. A 3-month carry roll on 1 year is roughly 40 basis points, and for 2-year it's around 25 basis points just on BTPs.
I can see that does indicate how bad things are. Greg, are you? What's your view from the US around issuers having access? Who's missing out? Who's got full access? Is there a difference like there is in Europe?
Oh, definitely. I mean, in terms of the haves and the have-nots, if you're talking about absolute access as opposed to kind of like just divergence in spreads and pricing, you have seen, particularly in the energy sector, obviously in the retail sector, in many names in high yield, the market is still sad for a big swathe of companies, and obviously the pace of restructuring in sectors like energy and retail has accelerated quite a bit, and we expect more. When it comes to investment grade, it feels like obviously there's new issue concessions that are being given, but if you're talking about access rather than pricing, I think generally the issue has been mainly on the high yield side still.
Do you feel that there's this is a bigger picture question for around, we've seen a lot of liquidity flow in, we've seen a lot of issuers take liquidity out. Does all the supply do anything other than just simply provide liquidity rather than helping solvency? Maybe Vinod, maybe you could take that.
Yeah, look, I think this is aimed at liquidity, and but I would say that they're quite closely linked in this environment where you have a severe shock. Liquidity and capital can get mixed up very quickly, or liquidity and solvency can get mixed up very quickly. So I do think this is about liquidity. If it was about solvency, you would have seen things like hybrid issuance. You would have seen distressed exchanges, distressed tenders, equity raises, etc. So I think you are looking much more at a liquidity response, and that does make a lot of sense if you're thinking about, especially if it's, for example, a V-shaped recovery, then you don't necessarily need to be raising capital at this point. You just need to bridge the gap.
But I think it's an interesting point, though, because arguably, the longer this goes on, then the more chances that this becomes a solvency issue. And I think what strikes me in the current market is if you're a single A corporate, it's all well and good, and you're barely paying any new issue premium, and you're getting huge order book. If you're cuspy or if you're sub-investment grade, then life is a lot harder. And I think investors are very much looking at those weak links, trying to identify those. And I think there's a possibility, they kind of see the possibility that a lot of these companies won't be in existence in the next sort of 3 to 5 years. I guess it's liquidity, but I guess it becomes solvency. And I think investors are certainly making the distinction between the stronger credits, and I don't think they're buying blindly. I think that, yeah.
No, agreed on that. And as I said, they are, I think, can become quite closely linked in a severe shock.
Okay. Just wanted to round out the conversation around the sovereign space and how that interlinks with the bank space and solvency issues. Has that old bank to sovereign doom loop kind of been resolved in this crisis, or are we just waiting for it to come back and rear its ugly head?
Is that to me, Alex, or is it?
Yeah, Vinod, would you take that? Yeah, sorry.
Yeah, sure. Look, I think banks through their LCR ratios and through their asset side will have direct links with the sovereign, and until you get a situation, I think, where you have like real debt monetization, where sovereign is issuing and the central bank is buying, you're always going to have that linkage. So I certainly don't think the doom loop has been resolved, as you put it. Now in the US, the Fed is just directly buying the paper, and potentially all the paper from the Fed, from the US government, but that's clearly not the case in Europe. And so I think that situation in Europe is going to persist. And if you look at how the market views that, as an example, I would say, in Italy, for example, if you look at UniCredit, which is has done all the right things, right? It's recapitalized, it's sold NPLs, it's got credible provisioning, still very reactive when something happens to BTPs, for example.
Okay. Vivian, what's your view on the linkages between the financial sector and the sovereign space?
Well, I agree that we haven't solved this doom loop, but what I would say is that we have to remember that banks play a critical role, just as fiscal policy is when it comes to the recovery and the crisis response. Extending credit. In 2008, the banks were the bad guys, and now they're the good guys. They've got the buffers, they've got the ability to help, and the central banks and regulators are pulling out all the stocks ensure that they can play a positive role. And I think they've got their backs, kind of thing, where they're not going to allow this loop to play out. Maybe after once we've passed the virus peak and we've gone through the liquidity side and all these other issues, maybe then we'll have to address these issues. But for the next a year, 2 years, I don't really see it as a big issue. And just to give you an example of the supportive role that these banks are playing, if you look at the Italian and Spanish banks, they purchased close to 20 billion of sovereign debt just in March. They are playing a key role. And what you're effectively seeing is the combination of debt management, fiscal policy, and monetary policy. That coordination via the banks is a key play in this current environment.
Okay. I just thought, before we're starting to run out of time, I just think there's a couple of things we haven't kind of addressed. I suppose the areas of where the market is clearly still broken, and I've got some points here. We've seen that that leveraged loan issuance, although it re-emerged in April, it's still dramatically down. It's the lowest level of activity since January 2019. And I suppose I'm going to kind of move on into the CLO space, because the CLOs are probably one of the key reasons for the leveraged loan market drying up. And that's obviously the CLO market has the parallels to the last crisis are there, that they are going to be, the CLO space is going to be hard hit by defaults of weaker companies, unless the Fed and the ECB are willing to really provide liquidity to a lot of very weak, very lowly rated companies. So I suppose what it does mean is that leveraged M&A is going to be on the back foot. We have seen some M&A activity pick up just of late. T-Mobile and Cornerstone on Demand Inc. Examples, but outside of the kind of, but in the leveraged space, that's going to be a problem. And CLOs are slowly coming back up, but they're very much conservatively structured, much smaller, and that suggests that backstop bid the CLO space has provided to leverage loan market is not going to come back. So, and that has infected the other securitization markets, I think. I don't think there's any really obvious reason why, apart from the fact the pricing might not be that great, but why the ABS market in the US and in Europe has stopped activity has stopped so sharply or reduced so sharply. We are seeing a few deals starting to emerge, but it's nothing like the activity we're seeing in the primary markets for the investment grade or even high yield in the US. So I suppose the question I'm asking or posing is that, is the financial system as strong or as weak as its weakest link? What's the weakest? All right,
just
sorry,
cut out
there. Yeah. Okay, what did you last hear me say? I'm sorry.
Weakest link.
The weakest link. So if that's the weakest link, is that a problem for the market? Does anyone have a view on that? Vivian, Helen, what do we think? Are we able to continue with this, or Greg, do we think we can continue in this way with one market hobbled and the rest of it seeming to move on?
I guess a lot of the times what we see in these crises is, kind of various market reopen and kind of things get better, and, the kind of riskiest part take for longer. So perhaps this is kind of the usual, traditional kind of scenario in the sense that, we've seen the kind of investment grade corporate market reopen, so that's all well and good. I guess in, financials, we've seen tentative sign of reopening on the subordinated debt front. And maybe it just takes a little bit longer for, these kind of the CLO market to reopen. But I guess there is a kind of broader question. If there is a kind of corporate, crisis, and, these CLOs arguably are stuffed full of, sort of high yield issues that could be challenged, maybe that does take longer, or maybe it doesn't reopen. It's a tricky one to answer, or maybe it's just a matter of time and for just a bit more confidence to return.
Alex, I would. Sorry, Divya, go for it.
No, go on, Vinod.
So I think if you look back to the financial crisis, which was kind of like a slow-moving train crash at the start, this has been much more sudden, and we've also seen the recovery in areas where the governments have stepped in to be much more sudden. So I think it's only been a couple of months into this. So I think the CLOs and leverage loans are a long way, especially in Europe, a long way from any government support. And so I think you're going to have to wait for, essentially, part of it is going to be the rising tide that lifts them, and other markets will have to recover first. And I think if you look at high yield in the US, it's been very active, right? And that's because the Fed has been buying ETFs, and the Fed has been buying fallen angels and things like that. So I think it is a matter of time, and I don't think that necessarily the rest of it's going to bring down the rest of the market. It's probably a case of the other way around. The rest of the market will pull it up.
Okay, thank you. I suppose the last question, last couple of questions I've got. What do we think around the fact that we've got these technical features that have been introduced by the central bank buying, and you've seen some inflows recently and back after record outflows in mutual funds and ETFs in March. So we've got a technical bid for credit, and at what point does that get challenged by the fundamentals of the fallout from the COVID crisis? The corporate sector dramatically slowing down in terms of real earnings, etc. Do we have a view on that? Is there?
I mean, I'd say related to your previous question, if I take it from a portfolio perspective, we've had a rude awakening in terms of various risks that we ignored previously because you got paid or you got alpha from just holding that kind of risk. Liquidity risk, concentration risk, tail risk. You didn't really hedge these kind of risks. Now, all of a sudden, these risks matter, and you're seeing a lot of demand for that tail kind of hedging risk. Where the market's standing now is largely on the back of the central banks having cut off that tail risk slightly. And I don't think we're past the point where we can say those risks have completely disappeared, because we don't know how the virus will progress. There's still uncertainty about the second wave. There's still uncertainty about the lockdowns and how they progress. And without certainty on there, it's very difficult to make decisions. But from a portfolio perspective, the universe has kind of shrunk further. Previously we were looking at the volume of negative yielding debt. Well, now we're looking at a universe where those bonds that used to yield 2-3%, they're no longer there. You're getting yields less than 1% on most govy bonds. I'm not sure where the average yield sits, but I'm sure it's below 1% now. So there's going to be an increase in savings, as we've already got corporates holding precautionary liquidity. So that savings has to go somewhere, and I think it's looking at smaller and smaller places to park their funds, and that's going to give you a market that's going to be quite diverse, where you've got clear winners and clear losers, similar to what we're seeing on the equity market side, where the tech stocks are seen as clear winners, and you can see how their performance, is influencing excessively the rest of the index. So I think I'm not sure if we have a chart, but they currently account for over 20% of the US equity market. Now that's a huge increase. And we don't have the chart, but we'll try and fish it out. But what we're seeing from a portfolio perspective is investors, although they're cognizant of concentration risk, they're actually being forced into concentrating their portfolios into smaller and smaller avenues to try and make a return. And that's going to become a lot more difficult once the market moves from technical to a fundamental phase.
Thank you. We have a couple of questions from the audience. I suppose I'm going to start with the last one, actually. Does anyone have a view on bonds of cruise ship companies? Well, I'll try and answer that. I don't think that I think that market, or those issuers are clearly in trouble, and that's the reason why they priced bonds at the level they did. Around 13%, I believe, was the Carnival level. And look, I suppose investors are taking a view that they are now in the new investors are in a better position to extract value if the company does go down, because they are the other investors were structurally subordinated. They've got these new investors have security where the other ones didn't. So I suppose that's the bottom line. They've layered the old investors, and desperate times lead to desperate measures. I don't know if anyone else has got a view on the cruise ship companies. If not, then I'll move on to the next one. Should debt given by government to companies be swapped to equity to avoid? Well, yeah, I suppose we could stop the question there. So would a debt for equity type swap work or be helpful? Vivian, have you had any thoughts around this? It's a bit off your normal wheelhouse, but
I think from that's a political decision, and in 2008 we saw a lot of backlash when we were handing out money to the banks, and this time around, if you're going to help corporates, then you've got to work out what's in it for the average man on the street, and I think it does make sense, only because the government should, if you've helped a company survive, then you should have a stake in its future, in the cash flow of its future. So I'm for it, but I can understand the arguments against it. But personally, I'm for it.
It would certainly increase the reticence of companies going to the government, and also I think if you're a debt holder versus an equity holder, you may have a very different experience. So a lot of the government equity injections still have not, or the government's equity injections certainly in Europe have not yielded taxpayer value. So, potentially you're probably better off keeping the debt, but having some warrants or something like that, so that you can, the taxpayer can get the upside, but it's also protected on the downside. Not that I want to give the government any ideas.
Okay. I think we're nearly at the end of the.
I think it's interesting.
Go on, Helen. Go ahead. Sorry, Helen.
I was just going to make a quick point. I think it's interesting. I mean, we've heard from the Commission, this week when they talked about companies getting state aid and companies' ability to pay coupons on their hybrids. And I think, to me, it certainly feels right that if you are getting some sort of government help, that perhaps you shouldn't be paying out coupons or dividend to equity holder and hybrid debt holders. That I feel like we've seen it. We saw it in the crisis with kind of sub debt, where bondholders were wiped out or asked to take losses, etc. And I kind of feel for corporates in a way it's a similar treatment. That would be fair.
Greg, what's the discussion like in the US? Is there a kind of any groundswell behind this type of action, or are we focused on other things?
With regards to debt being swapped into equity, or
I mean, in the US, we're seeing the Fed buying everything. Are there any discussions, views around whether that should be at some point swapped into equity? Do you think that's going to be part of the presidential election discussion? I mean, obviously, Biden is not probably as aggressive around state intervention as maybe some of his some of the potential other candidates would have been. But what do you think?
So we can look at what happened with airlines, and we can look at what happened with Boeing. When it comes to the Treasury administered programs, there was up to $50 billion in loan and grants allocated by the CARES Act for the Treasury to administer to the airlines, $4 billion for the cargo companies, and $17 billion for national security companies, or national security related companies. A fairly broad definition, but mostly related to Boeing. And Treasury Secretary Stephen Mnuchin was pretty adamant that when it came to most of the financial aid, because of the problem of the financial crisis, he did want the taxpayers to share on the upside, and he was keen on the government to have some sort of equity stake. They managed to limit that in the first $25 billion tranche that went to the airlines. This was essentially pass-through funding to basically pay the payrolls of the employees. And they managed to limit that to around 10%. And the airlines that have been the most dire of straits at the moment have now applied for the second $25 billion bucket of loans, and there are actually negotiations with the Treasury this week, and we have to see how much equity will come on that. But on the otherwise, you've seen how companies have been very reluctant. I mean, one of the main reasons that Boeing was keen to avoid Treasury funding, and they managed to avoid it for now, is they didn't want the equity dilution. Same for cargo companies, UPS, FedEx, XPR Logistics. Also, for PR regions, to the extent they managed to borrow commercially, they didn't want to touch government aid. But seems like with many of these companies, they would have to be forced to do it. What would be interesting to see as we approach the election, the political discourse, whether this argument emerges that given that there is so backstopping of these companies, so they take advantage in the commercial borrowing markets, whether it's CARES Act support available to the Treasury even though governments don't tap it, or whether it's this Fed support of the credit markets, whether the taxpayers should be getting kind of like more some sort of compensation for it. I mean, the Federal Reserve belongs to everyone in America theoretically, and a lot of companies have benefited, tremendously in the credit market by the Fed backstopping, even though the Fed hasn't got $1 in corporate bonds yet. Doesn't that have commercial value, and shouldn't kind of the tax, the U.S. taxpayer be compensated for that? So it would be interesting to see. That's a little bit of a nuanced, sophisticated argument. I don't know if that will catch on in the presidential election this year, or the general election in the U.S. But there is potential for this to become more political this year.
Okay. In the absence of any more questions in our Q&A, I think we are going to round up. Thank you very much for joining us, and thank you for to my panel for being giving us some time and being supportive on this. I just wanted to make sure that everyone understands that if you want to follow up, we can give you a recording of the webinar, and other related resources, they'll be available. So thank you very much for that and for your time. Goodbye.
Thanks, everyone.